going by the numbers on this company fundamental analysis coming up for you folks. So let's take a look at this iconic automotive company. We've been on a little bit of a nice. We've been on an upswing a little bit, hitting a 25 on the high range, $10 on the low range, and now we're creeping up, currently sitting at $16.18 a share. So through my analysis process, we're going to look at some key things, basically what the company has done in the last 5 years, what they're currently doing, and finally we will determine what the intrinsic value of Ford is and what we should be paying for it today. So this is what my software does, so take a look. So with Ford, looking at our company metrics, which compares the 5-year averages to the trailing 12 months, we're looking at any kind of discrepancies, and look at this, folks. PE right now is 5.57 compared to an average 5-year PE of 191.64. Wow, that's an incredible decline. EPS is up, our return on equity is up, and profit margin is up based off our 5-year numbers. Not too bad. This is actually looking pretty good. 4 categories looking pretty strong. Now, our revenue is currently sitting at $148 billion. Our net income is $11.67 billion. All right. Our free cash flow is $5.5 billion. Pretty good. As well as our 5-year average free cash flow is $11.3 billion. Okay, so a little bit of a decline in our trailing 12 months free cash flow, but it's a trailing 12 months. We'll see what this ends up a little bit later on. One thing I want to take a look at, though, is that we pay a dividend at 2.78% for our yield, and that comes out to be $403 million paid out in terms of dividends. And compared to our 5-year free cash flow, that's not an issue at all because, as I said, it's $11.3 billion, so they can easily pay that out, no problem. Our return on invested capital is much to be desired, sitting at 3.95, as well as our Allman Z-score is pretty bad. 1.24, folks. We want to see this number above 3, and we don't have that. And a very mediocre Piotrowski score. We want to see this between 7 and 9, folks. 9 being the highest number we can get. So, Ford, you had us in the first half. You're doing great. And the second half, not too great. Not too well. Huge amount of EPS growth over the last 5 years. Phenomenal. If you're owning the share, it's good to see that the earnings are being put to work, as well as they are buying back shares with share dilution going down just 0.5% over the last 5 years. So they are decreasing the amount of shares outstanding. That is healthy to see, as well as our net income has been going up. However, not so much has been green for this company. Other than that their platform is being changed over to the EV side, but we're seeing a large PE ratio average of 191 that we expressed, so that's been their 5-year average. That's been incredibly high, so we don't want to see that. We want to see companies that have a PE ratio beneath 22.5, so we don't have that. However, our trailing 12 months says otherwise, so something to keep in the back of our heads. Our current ratio is below 1.5. That indicates to us that they just have enough assets to cover their liabilities. And listen, a 1-to-1 ratio isn't terrible, but that 1.5 ratio for me is important because at least I know that they have that extra margin of safety. And if you're new to the channel, you know I'm a huge fan of buying companies with a decent margin of safety in my back pocket, because in case anything goes wrong, and in case I'm wrong, which sometimes I usually am, I want to make sure I'm wrong not that much. So with that in mind, our current ratio is 1.16. It's not the worst, it's not the best, but it's not getting any points from me. Our return on equity is below 15%, so it's getting scored 0 points there. And our debt to equity, oh my god, it is incredibly high, sitting at 184%, 0.36. Ugh, that's horrible. We want to see companies below 50%, folks, and that just indicates to us that they are leveraging their capital through equity within the business. They're growing it through means within the company and not taking on debt. There is a lot of incentive to not take on debt, but Ford is doing that anyway, so that's a huge red flag for me. Now, going based off these other categories that we have here, our free cash flow has been decreasing, so that's not healthy at all. Return on invested capital is below 10%, and our 5-year revenue is down 1.69%. That's not great. over the last 5 years, it's not great. It's been going down. So, folks, with Ford, I am not liking the numbers, not one bit. There's a lot of things that need to improve. Obviously, our free cash flow, if we're investing back into the business, that's important. But if our revenue growth is going down and continues to go down, like, let's just take a look at their income statement. Just a quick second here. Let's go to our annual. 2017, pretty high. 156 billion, 160, 155, 127, 130. Okay, so we're down quite a little bit. So what are my thoughts on Ford? By the numbers, I think we're in growing pains right now. And by what I mean by growing pains is that we are transitioning from being a petrol-based car company into an EV-based car company. So they're going to spend a lot of money on R&D to compete with the likes of GM, Volkswagen, and ultimately Tesla. So these are the in-between periods that are going to be so crucial for this company. So with that being said, I'm not too sure. I think there's a lot of potential for this company to grow in the future. So this is why we're going to do a price analysis to determine what we should be paying for this company today. We're going to fill out these lovely boxes to determine what we should be paying for Ford today. So stand by while I fill out these numbers. So before we jump into the last section here, if you're enjoying the video so far, hit that like button, hit the subscribe button. Ultimately, my process is based upon numerics, based on what the company does, and this is obviously the first step into researching a company. Obviously, there's a lot more, but I want to give you the foundation of where this company lies, because ultimately, you got to look at the fundamentals of the business, being the CEO, the company that's running the team behind the company and what they're doing and what moves they're making. But from a numerics perspective, it's helpful to know what this company can do and what they have been doing, and where we may predict where they might be going. If you're new to the channel, I like to stay conservative as possible. So with Ford, I gave them a negative 1% revenue growth on the conservative side, 0% revenue growth, so the revenue just stays the same for whatever it is on the moderate side, and then aggressive, I put 2%. Just give them some slack so they turn themselves around. Profit margin, I like to go 3, 3.5, and 4. I like to stay as conservative as possible to give myself the most ample margin of safety. That's why I did 6, 7, and 8 for free cash flow. Price to free cash flow, I did 12, 13, and 14. And PE ratio, I did 5, 6, and 7. Potentially a little bit aggressive there because I got 5 here, but way more conservative than our 191 that we currently have here. The desired return of 13%, and we're going to calculate what that comes out to be. Take a look at this. Take a look at this, guys. Our current price is $16.18. Our average calculations comes out to be $18.75. So we're almost pretty much trading at fair value. Take a look at this. And here's the interesting category, is our 0% revenue growth over the next 10 years. So basically, their revenue just stays the same. Let's say we make $148 billion. Year over year, next 10 years, nothing changes, and assuming a PE ratio of 6. Comes out to be 23.84 on our DCF, but it averages out to be 17.45. Now, does that mean they're going to do that? Potentially not. They may be going up next couple of 10 years at 2% revenue growth, which are very, very low numbers if you think about it. But at -1, we're almost there. Take a look at that. $13 on the low end. This may be a buy. This may be a buy if you can get around this huge debt to equity that they have here, as well as the negative free cash flow. See, if I saw a lot more green on this board here, this would make this a lot more attractive. But here's why I like to stay conservative, folks, to give myself the most margin of safety as possible. And I'll keep drilling that in to your heads as long as I live, because if you don't stay conservative to a certain extent, you are going to run into some problems. You're going to run into this speculation mode of, oh, I believe the company's going to do this, and it's going to 2x, 3x, 4x. People that use that kind of jargon have no idea what they're talking about. I have no idea what this company is going to do in terms of stock price. All I know is what they potentially could do in terms of revenue and growth, and where that stock price lies embedded into that free cash flow, net income, and revenue. That's my job to try to figure out. So, with Ford, if I can assume a negative 1% and 0% revenue growth over the next 10 years, it may be this $16 per share may be the fair value if it continues to do that. Do I think it's going to stay at these numbers? No, I think they're going to potentially do pretty well. However, I got to assume, but based off what they've shown me, that it may line in here.